All right, so let's look through here. I extended the deadline for Chapter 3 since last Wednesday was canceled. It's due on the 26th. If we talk about Chapter 4, it's also due on the 26th. So not this Friday here, the 19th, but which it would have been. Both of them would have been this Friday. Instead, they're going to be due the 26th. Quiz 5-1 is also available. It's still due there. Work on it as if it's due then. If we really are still falling pretty behind, maybe we'll rejigger some things with the rest of the deadlines, but work on it as if it's due then. If you haven't noticed, all the deadlines are the end of the week that it's assigned on Friday at the end of the day. And part of that is a little selfish on my part, so I don't have, if they do Saturday or Sunday, then I get a bunch of emails over the weekend. What's this? How do I do this? Because, people sometimes, some of you, not you, but sometimes students will start the project like right before it's due. None of you would do that. I know. Trust you too much. So it's due on Fridays. If you need a weekend to work on it, then I suggest you work ahead the weekend before. There's a Friday before weekend. It's 6 days before. So you have weekends available to work on these things. So let's talk about Chapter 3. Chapter 3 in the textbook, cost, volume, profit analysis. We're going to go over basically splitting costs, this C function, into a fixed cost component and a variable cost component, which is not rocket science. We understand this. You recognize those terms, I'm sure. When I went through the archetypal decisions and traditional decisions in Chapter 2, those 4 classes we talked about briefly on the last class, which was a week and a half ago, we have this either-or sort of scenario, or at least a numerable number of alternatives, a countable number of alternatives. You have you have 2, or maybe 3, or maybe 4 different alternatives: make or buy, keep or drop, and you can set them up at a table. Now, when we look at Chapter 3 here, we're going to say, well, actually, there are other decisions we can make. We can have a decision where we have to choose a value within a range of values, and the mathy part of me says, well, that once you have a range of values, assuming a continuous function across that value, it means there are infinite different points you could pick. So we can't create a table without it crashing the system that has an infinite number of columns to decide, like we did in Chapter 2. So we're going to use some algebra here, and we'll get some terms along here, which are a review for you, I'm sure. That's why when I say in the textbook here, we use algebra to solve for these continuous variables that are across ranges. The key about these 2 types of costs, which again, I think a review, but just in case, helps to hammer this definition home. A variable cost varies with volume. A fixed cost doesn't. That's really what we're talking about. If your volume goes up, and what volume means the amount we're producing and selling. Just for the purposes of this discussion, assume you're selling the same number you're producing. We're not worried about inventory levels going up and down because you're producing more than you're selling. You're overthinking it. Volume, it's producing and selling. So are we doing a lot? 1 million? If we're going to sell 1 million this month, what costs are going to go up because of that? If we're selling 1 million hamburgers, the cost of buns is going to go up because the buns are part of the hamburger. If you're selling 1 million, and then if you're selling only 100 hamburgers this month, the cost of buns goes way down. Whereas the cost of the factory that produces those hamburgers, maybe we're frozen hamburger or something, frozen hamburgers you immediately eat up in the microwave and regret your life choices because they don't taste very good. The fixed cost of that factory, though, the lease and the equipment in there, it stays the same, whether you're producing 1 million out of that factory or 100. So that's a fixed cost. Variables are the buns that go up and down with volume. There are mixed costs, which really just means we have a fixed component of it and a variable component of it. So it costs me a certain amount to if you had an old-timey plan, nowadays the cell phone plans are all like everything included, but the old-timey plans, you'd get a certain number of minutes allowed, and that was your fixed cost every month. But then you could go over that, and you would pay like per minute, a variable portion. That's maybe the dumbest example here. Anyway, I'm not fixating on the idea of mixed costs. We can separate them out into variable and fixed components. And here's why I have them. A variable, the V here stands for the variable cost per unit times the quantity of units. So naturally, this chunk, which is VQ, this term combined there, is the variable cost, and it goes up and down with the quantity, which is the volume, up or down at the quantity of units we're producing and selling. F is just as alone. There's no Q there. So no matter whether Q is very high or Q is very low, F stays the same, fixed costs. And of course, revenue, the more you sell at a price P, it goes up. Okay, this is pretty simple, I think. So skip over into, now we're going to define contribution margin. This is a deceptively powerful idea. You wouldn't think it's powerful because it's so simple, but it's a deceptively powerful idea. So once we separate out costs into variable and fixed components, we can say, well, let's pit the price directly against the variable component, because the price goes up with quantity and the variable cost goes up with quantity. And then what's left over is really what contributes to our company. Everything else is just kind of passed through to another company, the supplier. It's like when you get your paycheck. Don't look at that top line number unless you want to be depressed, because that's not the amount you get. The amount, there are a bunch of things getting taken out of there. There's some guy named FICA who takes money from you before you get it. And you get these taxes taken out, is the joke. And so basically you're earning that cash as a pass through to the government. You don't see that money ever. It's withheld. You don't see it. It's kind of like the variable costs. You don't even want to consider that to a degree when you're considering how much your company has made. At least that's the analysis when we're making these kind of decisions. You want to scoop that out and say, well, how much is being contributed? So we have contribution margin. That's what that means. Sometimes it's called contribution. Sometimes I think there's a third term. I might have it up in the textbook somewhere, but I know people sometimes just say contribution. Also, you can say contribution margin, and you can have it in total. Like the total contribution margin is the total amount contributed by your sales, the total revenue minus the total variable cost. Because we have like all the sales we're making, the quantity of sales we're making. So we sold 1,000 units at $10. It means we're in 10,000 here. That's PQ is 10,000. And if they cost us $5 per unit, that 1,000 units times 5,000. So the total contribution here is that 10,000 of revenue, total revenue, minus the 5,000 total variable costs. And so the total contribution margin would be 5,000 right over here. And just ignore that for a minute here. You could also scroll on down a little further. I make the very analogy of you see this all the time, the idea of contribution. How much is your paycheck actually contributing to your personal finances? You can also do it on a per unit basis here. So you can just take per unit. We sell it at a price of $10 using the example I just came up in my head a second ago, minus the variable cost of $5. So the per unit contribution is $5. For every unit we sell, we earn $5 to do what? For the business to pay its fixed costs and then to make a profit, to pay back its debtors, and to expand the business as it goes forward. Because I mean, if the business is making a profit, presumably that's something that the customers want, the consumers want, and they get value out of it. We're not forcing them. It's a free market, so they have chosen to voluntarily give you the money. So if you have a profit, then yeah, you probably could expand. You could expand the business and provide the people more of what they want. That sounds like a pretty significant social good for the people. So we have unit contribution here on a unit basis. Unit CM and total CM are incredibly important concepts here, and we can also do it on a ratio basis. All right. So if you're one of the people who was a finance major, there were a few of those who we talked about a week and a half ago, the only other time we've seen each other. You tend to like the ratios, at least on average. I've seen finance people like the ratios a lot. Or maybe you're an accounting major, but you have a financial gene in you or something like that. So you like the ratios a lot. You can do it the same way. We can pull a P out of this algebraically, pull a P out, and so it ends up outside the parentheses. So this becomes just 1, P over P. And then this V doesn't have a P in it, so we just have V over P right here. And so then you have, this is the ratio right here, 1 minus variable cost over price. It's going to be end up times the sales revenue we have, PQ here. But this in the parentheses is the contribution margin ratio. So this is the variable cost ratio right here, this V over P. And I never use that. I don't have any questions that directly ask you about variable cost ratio. You only need that in this class so you can get the contribution margin. Just 1 minus that. Let me say that. Let me articulate that sentence, enunciate it. You only need the variable cost ratio here so you can get the contribution margin ratio, which is 1 minus that. So the inverse of the, is that the right word for it? I'm going to use that word. The inverse of the variable cost ratio. At least as far as this class is concerned, that's the only thing you need it for. But yeah, what's in the parentheses here is the CM ratio, like it says. And we can do all sorts of fun things with these, like solve problems that are due next Friday. We can do all sorts of fun things with CM ratio, unit CM, primarily, sometimes total CM. And you can also define CM ratio as unit contribution margin per price. So if you want the layman's way of looking at this, as a student, I loved unit contribution margin. I primarily went that direction. I always liked that way of conceptualizing it. Well, how many dollars is one unit of sales earning me? Once I take out the variable cost, which I'm just passing through that money to the suppliers, the bun maker who provided me with the buns, I had to pay them, so I'm just passing part of the money through. Once I've taken that away, how much is actually coming to the business to pay our fixed costs and so that we can grow and better and continue satisfying customers? I like that way of conceptualizing it. CM ratio is, if it doesn't come naturally to you, like it didn't come naturally to me, you can think of it a lot like, well, per dollar of sales, what percentage of that dollar is coming through? What fraction of that dollar? So CM ratio will be below 1, unless somehow you have negative variable costs. It has to be below 1. Because it could be at 1, at or below 1. So how many dollars come through to contribute to our company to pay fixed costs and then earn a profit so we can expand and grow per dollar of sales? So that helps you rationalize what this kind of term means. Then great. All right, so target profit analysis and break-even analysis. So two of the questions that we have to answer using a continuous variable is we have to solve for the quantity we're going to make, the volume we have to sell to break even, or to make a target profit. Usually it's because we have to make that much to sell to pay back the creditors or owners of the firm or whatever. We can do that in the quantity of units being sold or in the total revenue being earned, the total revenue being sold, or total sales. Now, say it that way. And so these two problems sound like they might be different, but they're actually the same. Just break-even analysis is a special case of target profit analysis where the target profit is 0. So it's the simplest case of target profit analysis. But these two are the equations, right here and right down here. So the basic idea is, these are the problems. Problems ask you this. This is the procedure you're going to go through with the actual problems on quiz 3, is that we have a certain fixed cost we have to cover and a target profit. And in break-even analysis, it's 0. So it's just F here in the numerator, right? 0 plus F. So we have a numerator, and we're going to divide that by how much we earn, how much money contributes per unit of sales. And the quotient here is our quantity at whatever that target profit is. And when we're talking about break even, target profit is 0. How much does it take for us to earn a 0 profit? And with CM ratio, just the same thing, except over here, of course, is a different term we're solving for. But notice the similarities here and here. You're always dividing by CM, either the unit CM or the CM ratio. What it gives us, though, is the total sales we need to reach that target profit. So this is the total sales we need at this CM ratio to reach this target profit given these fixed costs. And so actually, let's jump into problem or two. Let's see if we can't. Wrong link. I don't want to navigate the modules that way. This one right here. Let's take it. Okay, this is a great CVP question. Nice simple one. So a firm sells a product. Let me set up a little bit better here. All right, so a firm sells a product with a unit price of $110. Oh. This is P in the equations we just talked about. Variable costs are $10 per unit. So that's variable cost per unit, or V, in the equation we just talked about, which means that the net of those, the $100, is our unit contribution margin. Not too bad. We have fixed costs of $10,000 and target profit of $60,000. So the numerator here is the sum of those two. Numerator right here. Target profit plus fixed costs. This is our numerator for the problem. How much we are asking, what is the Q if we're going to earn $70,000 to pay for $10,000 fixed costs and earn a profit of $60,000 to pay back debtors or to expand as we want. And so the answer is going to be this numerator divided by the denominator. So that's going to be our unit sales at target profit. So not too hard to apply these equations here. Now we could go a little different. So I'll roll down the thing here. Roll down a little bit here. We went from unit contribution margin to quantity required for target profit. This is kind of a problem-solving matrix for you of how you can transition between all these things. We took pi plus f over the unit contribution margin. That's what we did. Now we could solve this problem with the CM ratio. So alternatively, we could say we know that we're going to earn so the CM ratio here is our contribution margin over the unit price. And if I define that nice and clear up here somewhere. Yeah, unit contribution margin over the price. So that's our CM ratio. And if we go back down to the problem-solving matrix, we can apply that in the denominator, and we'll end up with the target sales required. And we can take that target sales and turn it into just unit sales here in a minute. So we can take this 70,000 divided by this 0.91 CM ratio. Look where I got that distractor answer. And this is our target sales, target total sales at, now let's say it this way. Target sales revenue. This is in dollars, that's the idea. At target profit. I only say target twice. Okay. This is in the, by the way, this is in the shared folder. You'll have access to this, what I'm typing here, if you want. It'll be there. I don't want to navigate away from this, but it'll be easy to find. So you don't have to copy everything I'm doing down if you were doing it. So this is our target sales. This is the total sales at target profit here. And we can divide that. Well, every sale is $110. So that means 700 unit sales at target profit. So it's this big, lovely, squared circle sort of thing that you can just keep going around and around, figure out what all these are related to, because they're interrelations that are nice, and if you're mathematically minded, it just looks really beautiful to you. So 700. The point is, at the end of the day, that 700 units is the right answer. That's the Q at which we will earn $60,000, given this setup right here. Great, nice and easy. Let's go to a little bit of a different kind of question. And let's look at 3 products. So we're jumping a little down, but it makes sense. That's what we're doing to kind of layer it on top of that. So these are the same equations we saw before, except they've got this big composite word in them. So before, we had these right here. Unit CM was in the denominator. And now we have composite unit CM in the denominator. And we get composite unit quantity. So what we have to do when we have multiple products is we have to figure out how to create a composite unit of some kind. We're going to take this sales mix and use it to say, well, let's create a composite unit so we can do the math the same way and make it easy on ourselves. All right, so this is CDP problem 1. This is multi-product. So we have here, let's see if it'll copy over nicely. It did. Good. We have here, if you like, this is, I think this is the Battle of Waterloo, was my inspiration for these names. All right, so the firm Prussian Clausewitz produces 3 products, Blücher, Napoleon, and Wellington, and their total sales mix of 1 to 3 to 2. All right, so we're saying that we sell a bunch of things in the store, 3 things in the store, and people come in and they buy them at different rates. We sell about 1 Blücher in a given month, or in a given period of time, maybe a minute, maybe an hour, maybe a day, maybe a month, whatever. And we'll sell about 3 Napoleons in that same time frame, and about 2 Wellingtons in the same time frame. And so we have this arrangement of sibling products, brother or sister products here. And we've got the price per unit for each of these. These are high-end items, so to a degree, I guess. I mean, I guess maybe not for a car, but for other things, they'd be pretty high-end. And we have the variable cost right here. I'm actually going to go ahead and let that be cut off. I don't want to push us too far off the edge. I'll move us over to get us in line with the B column for CVP problem 1. We'll keep that here. So what we want to do here is we want to say, let's figure out the CM ratio for each one of these, first of all. The unit CM for each one of these. So every Blücher we sell, we earn $1,000 in contribution. For every Napoleon we sell, we earn $13,000 in contribution to contribute to paying our fixed costs and to earning a profit so we can grow and expand. And when for each Wellington we sell, we earn $10,000 in contribution. Great, we've got that. Oh, I gotta make sure I do this with the video right. In fact, I'm gonna switch sides of this because the video, you saw it for a second, has the little cutout in the bottom right corner, which will block the screen. All right, so now what we need to do is apply the sales mix. Okay, so we're going to build a composite unit. We're going to say, let's just assume, it doesn't really happen, but we're going to assume for the purpose of the math that we sell them in literal bundles. Like literally you come in, you buy a Waterloo bundle in which you get 1 Blücher, 3 Napoleons, and 2 Wellingtons. And people come in and they buy a Waterloo and then they walk out of the store. That's the composite unit. We're going to say, how much contribution do we get per composite unit that we sell? We're going to sum that. Okay, so because we sell only 1 Blücher per Waterloo per composite unit, each composite unit gives us $1,000 from that. We sell 3 of the $13,000 per contribution margin Napoleons, so that gives us $39,000 contribution margin from the Napoleons in each bundle, each composite unit, and $10,000 per Wellington times 2 Wellingtons in the bundle gives us $20,000 of contribution in that. From Wellingtons in the bundle. So we end up with a total of $60,000 of contribution from the overall bundle for each bundle that we sell. And now we can act like that's our unit of sale. It has built into it the sales mix that we've observed through whatever I observed when I made up this number. If this were a real company, we'd have observed the actual sales over time. So yeah, they're sold in about this ratio. And we're trying to project out how much we need to break even next year. Maybe the Waterloo movie, the Napoleon movie was really, really underwhelming. And so we're like, I think sales are going to go down. How are we going to stay in business? Because Waterloo is everybody's favorite topic. It's flying off the shelves. And so, yeah, we're trying to figure out what break even will be. I'll say, okay, we know all this data. We know what our mix is. So let's figure out how much we have to sell to break even. So it's the same thing as before, in the sense of we just put the composite unit CM, which is our 60,000 here, in the denominator underneath our target profit plus fixed cost. This is a break-even problem right here. And that means our target profit is 0. So we're literally just going to say 6 million. We'll check that. Yeah. Other way. Is our fixed costs we're covering. And just for completeness, drive the point home even further. Target profit, of course, is 0 because it's a break-even problem. I'm so used to in Excel having to hit F2 so I can go back. That in Google Sheets here, I don't have to, and that's sometimes I hit it, and then it's like, oh, you don't want to go back. You want to scroll cell to cell. Anyway, 6 million as our numerator, the amount we have to cover. Numerator here, divided by our composite units of $60,000. Sorry, our composite unit contribution margin, $6,000, means that we need 100 what? Composite units. Thank you. Not 100 Napoleon units. Don't fall for that sneaky professor who wrote that in there and is trying to trick you. My evil twin who wrote that. Nope, that's good. I'm going to get some of you on this kind of thing. No, that is composite units at break even. Now, each composite unit is a bundle of 1 Blücher, 3 Napoleons, and 2 Wellingtons. So it's asking how many Napoleon units do we have to sell at break even? Well, I have to convert it back into how many Napoleons. 100 composite units with 3 Napoleons per composite unit means that we have 300 Napoleons. In units at break even. P/C is for break even. Great. Okay, so we have multi-product problems we can do, single product problems we can do. Here's me. I must have been in a war mood here because this is Clausewitz for forget the name of his war tome, but it was where he said war is diplomacy by other means, or something like politics by other means, something like that. And Sun Tzu here, man, it's cultural enrichment for you there. You're getting all sorts of fun stuff there. I want a different problem. There's a different style problem that I think I'm just going to have to do another run, another draw. Okay, let's submit that. Make sure we got those 2 right. Should get 5 points. Yeah, 5 points out of 25. We got the 2 right. We answered. Let's do another draw. I want one of these problems that I can use. I have to use a CM ratio on. No, let's try it again. I might give up after this one. Well, I don't have one that I have to use the CM ratio. But I can pick one that wait. Oh, this is one of them, actually, yes. Okay. So if we're trying to follow my procedure here for question 6 here, we're going to label this CM ratio problem. We're going to have some trouble because I have a sales mix, but I don't have individual information about each of these 3 products. I know they're sold in, if I try to copy this over, this is A, B, and C, and I know they're sold in 2 to 6 to 5. I cannot solve it because I have question marks all over the place. I don't know the price per unit. I don't know the variable cost per unit. And it's still, this may be a problem we can solve. I do have some that I have this down here, and it's not a distractor. And indeed, I have not given you enough information. But I think this is one we can solve with this information. The answer is that this right here, specifically this $1 million and this $70,000, has the sales mix built into it. If we sold our 3 units at 2 to 6 to 5 and it produced these numbers, then the CM ratio those 2 numbers represent will maintain as long as we're keeping that 2 to 6 to 5 next year. So we can get around the whole rigmarole. If you were like me, you would be hating me right now because I've created a question here where you have to use a CM ratio. As a accounting student, bachelor's, I liked unit CM so much, I just cursed the bones of CM ratio every time I saw it. But this one, you have to go with a CM ratio because you can't solve it with unit contribution. Those are unknowable. But the CM ratio, you can know. I don't want to leave that. Nobody's going to be offended if you look back at this spreadsheet. You're like, oh, it's gone. I don't want to leave it. I just was illustrating a point. What we have total revenue of 1 million. We have 700,000 total variable costs, which means our total contribution margin is 300,000, which means our CM ratio is 0.3. So 30 cents on the dollar for every dollar in sales is what's contributed to our to covering fixed costs and to earning a target profit. We also know our fixed costs. And it says in the problem we have a target profit. So yeah, this is the critical assumption that I include. I think I've included in every problem that does this, but if not, it's almost always, it's there. Just assume it is there. If I've forgotten to write this particular thing, that's the way you do this problem. I'm assuming this cost structure of given a million in sales, we have 700,000 in variable costs, stays the same. And then also I want to include the idea of the sales mix as well, being part of what I'm saying when I say the firm's cost structure staying the same. How much total revenue will the firm need to earn a profit of 600,000? Well, this is our numerator. We have to earn back 100,000 to pay off fixed costs and 600,000 more to reach target profit. So our numerator is 700,000, and we can just divide it by the 0.3. So that should be our target. No, how did I say it? Say a total revenue at target profit. 2.3 million. This one right here. So the multi-product CVP problems are a little easier because the ones that use the CM ratio are a little easier because it's all baked into the cake of this cost structure, which is expressed in one number with this 0.3. So, for example, this problem right here, we do the same thing. Right? We've summed it all. We can say the cost structure is, the CM ratio is 0.63. So we earn 63 cents of contribution per dollar in sales that we make. And you could take this numerator then, divided by that's 0.63, and you put that amount in sales. No, I'm getting wrong here. I need to take that, I believe. How am I converting this wrong? Honestly, I'm not going to worry about moving back down to get to units here because, yeah, this is fine. Because the problem, if you're required to go the CM ratio route, it would be asking for this number in the end. So you can elide a bit of this issue right here by taking these overall numbers, getting the CM ratio that is inferred by these. No, I know what I did wrong. Yes. Okay. This is why I did it wrong, because I'm off the fly deciding to adapt this problem to a different one. Okay, if this did reflect the sales mix, but it doesn't. I've assumed that I sell 1 to 1 to 1. I've taken this sum. So instead, I need to say this is where I'm going to do that thing I was doing. So each composite unit, let's get rid of that. So given our sales mix, we're multiplying the sales revenue of each unit times the sales mix. So given our per composite unit thing here, we should be selling 89,000. And now we'll get the right CM ratio. All right. That should be our total revenue at which we break even. Yeah, so this includes enough to pay for the variable costs and then 6 million left over to pay for the fixed costs. But I don't want to get distracted too much further, try to make that all look lovely. point of it is we can get that number without having to go through all these columns. I present those problems. I give you this number. I give you that number so you can get this number. So this, so you can get that. And then you get the CM ratio. And it's built in the fact that these are built off of the 2 to 5 to 6 sales mix. Solved it. Great. I don't know. I came to like CM ratio later in life here. All right. There are other problems that I saw here. This one. Let's jump to an idea that's introduced later. I want to make sure we go over it because there is, on every single attempt of the quiz, I've made sure, because I made enough problems for it to make sense. I'm going to skip past degree of operating leverage and margin of safety. I'll come back to that. But this constrained resource decision, because it's such a horse of a different color that I want to make sure we have some time to look at this. All right, so sometimes we're not solving for Q. Sometimes, or rather, not solving for Q in a vacuum. We want to know maximum quantities, or we're deciding amounts to produce so we can sell, but we have some constraints, which is more like life. You don't just say, well, how many sales do you want to make? How about infinity sales? Oh, you solved the problem. Okay, you win. Like that. That'd be a real business class would be really short. How many sales do you want? Maximum. All of them. All the sales. Okay. You win the game. Good. You can't just pick a Q. There's some upper limit to the Q. There's some upper limit to how much the monthly demand is going to be. That's how these problems are expressed for your different products. And so, yeah, we have corporation because these kind of problems sometimes give people some jitters. And oh, no way, 3 different products we have. And we have, I'm going to copy these over. Oh, I did that 2 thing product again. Now I suddenly am wanting. And we have a constraint. Here's the problem. We have a couple constraints here, but one that we're going to focus on. We have monthly demand for each of these products. We have a max amount that we can sell of each of these products. And we have a production constraint as well. So the market is constrained as well as our own production. We only have 1,200 hours of machine time for these 3 product lines. If you haven't noticed, I want to make sure I point out here, you'll see a number of problems that look very similar. They aren't exactly similar. They aren't the same, rather. A number of them just have small changes. Please be careful reading them. Where possible, and where I have remembered to do it, or I've done it, I decided to do it where possible, and I think on every problem, I'll say it this way, I've bolded the thing that changes. So some of the problems that look like just like this have different machine hours per unit and monthly demand in units and a different amount of the constraint. Those are the ones that are gonna vary. I wanted to do that out of the kindness of my heart because I know one of you will say, I just had this problem and I'm going to pick the answer that looks right based on my memory of the old problem and not realize it's a different problem with very different fact pattern. So I'm saying, look at these specifically before you decide this is the same as a previous problem you saw. So yeah, we only have 1,200 hours of machine, and depending on the problem, this might not be enough to cover all this demand. So I can test that real quick, just to make sure. Yeah. If we satisfied all 50 units of demand from O, and all 60 units from No, and all 70 units from Way, given how much machine time each of these products uses, we would consume 500 plus 360 plus 700, which is 1560 machine hours. So we can't do that. We're going to have to prioritize the machine hours. We got to put the machine on what's going to be most profitable to the firm, what's going to contribute most to the firm. Contribute, key word there. We're going to use contribution margin to do this. Not just contribution margin. We're going to take contribution margin divided by constraint used per unit. That's the key innovation you have to do. So I'm going to get rid of this. That was just to show you that we can't meet all the demand. First of all, we have contribution margin. And if you just went here and you stopped there, which you might be tempted to do, you would say, oh, well, whey is our most profitable product. We earn $20 of contribution per sale of whey. And no is the second most profitable, $13 contribution per unit of no. And you could say, oh, is our third most profitable $10? Great, you could prioritize them like that. So we're going to first fill demand of whey, and if we have leftovers, we're going to fill demand of no, and any leftovers, we're going to finally fill demand of O. Go like that. That would be a mistake. And with most of these problems, I have a distractor choice that is that answer, so you will get it wrong. We have to do the division that I just described a second ago. We have to say, we get $10 per sale, but it consumes 10 hours of machine time. Wow, that is machine pricey here. There, I want that. Yeah, so per hour of machine time, oh, it is a dollar amount. Yeah, sorry, I got ahead of myself. This is the CM per unit of constraint, is what this is. It's not a really succinct or short term, but it describes fully what it is. So we earn $1 of contribution per hour per unit of the constrained resource that we devote to O. We earn $2.17 given 13 contribution and 6 hours of machine time per unit. And we earn $2 of contribution per hour machine time devoted to whey. All right, so now the priorities have changed. I'll do it this way. Naive priorities. Worth 1, then 2, then 3. No, these are numbers. The correct priorities are, oh, look, we earn the most contribution per machine hour when we devote it to no. Second most to whey, and third most to O. So that's the order in which we're gonna go ahead and fill monthly demand. All right, so we're going to start here. I'm going to say we're going to fill 60 units at 6 machine hours per. And I'm going to add a little line up here. So of the 1,200, we're going to use up 360. All right, so this is units sold, produced and sold. And this is constraint consumed. And this is remaining constraint. And those units time the contribution per unit. And this is the CM from, this is total CM. CM at the product level for this product. I'll call it product line. There we go. And over here, we're going to sum that. Because down here at the bottom, I'm going to sum all three of these. Okay, so now that was priority 1. We filled all of our demand, used up 360 units of the constraint. We have 840 left to use for whey and then for O. And our total contribution margin from our no product here is going to be $780. Great. Okay, great. I'm going to copy that over now for the second one. Let's see how nicely it will copy. It won't. I didn't make any of this absolute. Anyway, how about I do that? Where'd my thing go? Go away. I want that one to be absolute. I want that to be absolute. I want that to be absolute. So let's try that. Okay, so now we're going to fill all the demand for whey. 70 units is the total monthly demand we have. So we're going to fill all 70. They are just a little, there we go. 10 machine hours per unit. So that means we're going to use 700 constraint units right there. And I copied it down one too far. There. And we should have, oh, I know I don't want that absolute. Or I don't want that one right there. We had 840 left over after we used up some of the constraint for no. And so after we use up the 700 for whey, we have 140 left over. Now, it's possible on some of these problems, you get the second product and you end up with a negative amount of constraint, which you can't do. You only have 1,200 hours. That means that you need to go back and say, this is the last product we can produce. We can't produce any O in that case. Okay, let's see if we can copy this down, and we'll have to manually fix one of the cells, but that's not too bad. A couple of the cells, actually. So we don't know how many units we're going to sell, actually. We do know that we're going to consume the remainder of the constraint, 140 units, because I knew from the earlier problem, we have 500. If we filled all the demand, we'd have to use 500 units of the constraint. So we're just going to use up the rest of the constraint. That's what I'm doing, right? This cell right here, C71, says, well, let's point to the remaining constraint. We're going to use all of it up. Our unit sold is going to be that amount divided by however much it takes per unit. So it looks like we can sell 14 units of O. We can only fill 14 units of demand here. Because it's the least profitable per unit of the constraint, that's okay. We're maximizing our contribution by not filling all the demand for O. Now the remaining constraint is going to be 0 just by dint of what it has to be. This 140 minus this 140. And total product line, let's see if it's saved. Yeah, $10 times 14 gives us 140 there. That's our total contribution margin from the O product. And our total overall, 2,320. That should be the right answer. Right there. Now, I know one mistake we can make. You can forget those constraints. You can say, well, I'm going to produce all the products. I want all the products. I want to fill all the demand. More power to you, but I've told you you can only supply 1,200 hours of machine time. So you've ignored that constraint. You've actually gone 360 hours over what you have available to you. And you get this answer, and it's available because I'm mean, and I put it there, and you're wrong. Don't do that. So that's this style of question, and should be on every single attempt you make, this kind of question. And I want to include it because it's in this same general style. We also need to figure out some special order problems and some degree of operating leverage and margin of safety problems. So let's talk about, let's go back to the margin of safety, degree of operating leverage world for a minute here. If it exists. Well, there's a degree of operating leverage problem. All right, so let's go back up in the chapter here. And I want to explain margin of safety without doing a problem so we can do it quickly. Margin of safety here, before I get a degree of operating leverage in that problem right there. Margin of safety is actually really simple. So we have the idea of a break-even point. I think we understand that. I usually don't get questions about that. And it's when we have target profit of 0. That's our break-even point. Margin of safety is how far we are from the break-even point. Because, it's unsafe to not break even. So safety, margin of safety. What's our margin of safety? In terms of either total sales in dollars or in terms of unit sales. The question will ask for sure what it is. Now, what's our margin of safety in units? So how many units are we away from breaking even? How many units more are we selling than we would sell if we were breaking even? Okay, so it's very simple in terms of you solve a break-even problem and then you do a subtraction. That's it. You take your current sales minus the break-even point, and that difference there is your margin of safety. I think that's pretty easy. People can solve break-even problems. and then sometimes they forget about the margin of safety piece. We can look at that if we really have time for it. Degree of operating leverage is a different animal. I put them together in my mind, but they're different. It's a different animal. It's a different section of the textbook and everything. And so what we're trying to do here is describe the other part of the contribution margin style income statement. Contribution margin style income statement says total sales minus variable costs. Total variable costs gives us total contribution margin. I'll even put less fixed costs gives us profit. Okay, not getting real fancy. I know if you're an intermediate right now, you're like, it's much more complicated. I know. But for internal purposes, this is what we're going to break it out as. For internal purposes, there's no FASB looking over your shoulder and saying, well, did you do that right? No, there's just economic reality. And if you're reflecting economic reality, then you're doing it right. So we just need this level of specificity for these kinds of questions we're asking as a company. And so what I'm saying is CM ratio expresses this top part of our contribution margin style income statement. Degree of operating leverage expresses the other half. And so the two move in harmony typically. I'll explain that in a second. All right, so we have CM ratio, which is total CM over total sales, or it's the same ratio whether it's unit sales, unit price over unit CM. Excuse me, vice versa. Unit CM over unit price, sorry. But the ratio is the same because total CM is just unit CM times the quantity you're selling, and total sales is just the price per unit times the quantity you're selling. So the Q's cancel out is the idea. So that's the CM ratio, and that expresses the relationship between this block right here and this block right here. And so this right here is how much sales, how many dollars we're losing from variable costs. We're passing through to the next company. Degree of operating leverage takes total contribution margin over that profit amount, which is what happens after you take out fixed costs. And says, all right, well, let's express via ratio how much this is greater than this. Now, one thing to notice is that total contribution margin is in the numerator on both of these. Contribution margin is king. There's a C and a K kind of K sound going on there. Contribution margin is king. Maybe that helps you mnemonically. Yeah, king or queen. Oh, you could put the K sound in the queen as well. King or queen of the CBP kingdom. And so it's in the numerator. What that means is, while CM ratio has to be 1 or below, degree of operating leverage has to be 1 or above. Just the math is flipped as a result of that. Because this is CM ratio, which is the bottom piece, over total sales, which is the top piece. Whereas here, it's the top piece over the bottom piece. Again, unless you have somehow negative fixed costs, in which case, sign me up for that business. You're going to have a DOL, a degree of operating leverage that is higher than 1 or higher. And so typically companies trade these two off. In fact, that is the point of, where did it go? I'll get to it. Promise. This clip right here. I'm not going to go into it. We're not going to watch it in class. Some semesters I do, but it's there for your convenience because what this negotiation is about, it really is CVP. They're trying to get Johnny, the farmer, to increase the price at which he's selling to customers so they can fit in some fixed costs because they wanted to move his cost structure from a variable cost heavy cost structure to a fixed cost heavy cost structure. So they can increase distribution that's going to be fixed costs. They want a piece of those fixed costs is the idea. This is typically trade-off. Yeah. Either we're doing one-off things that are variable costs and other companies are providing them for us. We're buying these variable costs that come in. Or we own something. We've made kind of the make or buy decision a little bit here. We own the means of it. We own the equipment, the intellectual property, the subsidiary company, whatever it is, and it's a fixed cost to us, and we have some sort of way of in-house creating that. We typically trade off variable costs versus fixed costs. And usually the rule of thumb for this is if you believe the idea is pretty good, there's a lot of certainty about the idea, you load up on fixed costs because that is going to give you greater economies of scale. You can scale that up, which is what they're trying to do with Johnny here in the clip. Okay, there's a quiz question that asks you that, but for your information, usually you have either, and because of the way that the fractions are flipped, they both either go high or they both either go low. So for example, if I have a lot of variable costs, I'm going to have a low contribution margin. That means that let's redraw this and say this triangle actually comes all the way out over here. A lot of my costs are taken up by variable costs. That means I'm going to have a small numerator compared to my denominator. I'm going to have a low CM ratio, maybe 0.5, 0.4, 0.3, to reflect that I get very few cents after I've taken out all the variable costs. Usually that means, though, that I'm taking care of a lot of my costs through external vendors and variable costs, and so I might not own many of these costs myself. So I don't have these fixed costs laying me down. I likely have a pretty like I visually put it right here, right? That's why I'm saying this rectangle ends. Well, then I have this chunk over this chunk right here. There's not that big of a difference between them. Total CM here is not that much bigger than the profit at the bottom because I'm taking out much fewer fixed costs. And so my degree of operating leverage is also relatively low. In plain English, what degree of operating leverage says is how many contribution margin dollars does it take to earn $1 of profit. That's the opposite of what we said. Again, like I said, it's flipped. We said how many sales dollars do I need to get contribution margin for CM ratio. Now I'm saying how many contribution margin dollars do I need wait. No, I said how many. Sorry, I said the first one wrong. First one, CM ratio here is how many cents of contribution, how many dollars of contribution do I get per dollar of sales? So it's 0.7, 0.8. I get 80 cents, 70 cents, 50 cents on the dollar. Here I'm saying how many dollars of contribution does it take to get $1 of profit? There we go. Okay. And so yeah, I likely have a pretty high, a low CM ratio, so like 0.4, 0.3, whatever, because I have a lot of variable costs, and then I probably have fewer fixed costs, so I might have 1.2. It takes me only $1.2 of contribution to earn $1 of profit. Whereas instead, if I do what the sharks are trying to tell Johnny in the clip that's here, I likely load up on fixed costs because I'm trying to scale the business because I think it's a sure thing, and I'm not doing as many one-off variable costs. And so let's say it goes way over here. So I have a pretty high contribution margin ratio. It's like 0.8, 0.9 or whatever, but I own a lot of fixed costs. I've taken up some debt. I've gotten some equipment. I've created long-term relationships with distributors and so on and so forth. And so I have a lot of contribution margin dollars required to get $1 of sales. So I probably have a high DOL and a high contribution. They go up and down the same way. All that to say, let's do a problem about DOL down here. Yeah, it was up further. Yeah, it's the very second problem here. Okay, so a firm sells a single product. So first of all, I'll use my trick. Let's read the question stem first. So if the firm sells a certain amount this period, what is its degree of operating leverage? So I have to solve for DOL, which is right here. DOL is total contribution margin over the profit, which is profit is just total contribution margin minus the fixed cost. A singe product. Oh, I should fix that. I will make a note to fix typo on that problem. Fix single typo. Okay, so let's read now that we've read the question set, we know it's a degree of operating leverage problem. We know now we're going to read the fact pattern here. The firm sells a single product for $37 per unit. The product costs the firm $28 in variable cost to make. Okay, so we know we have $9 of contribution per unit. 37 minus 28 gives us $9. The firm also incurs this amount right here of fixed costs in the period. All right, we're trying to sell, or excuse me, we do sell this amount. What's our degree of operating leverage? So let me just chart out the whole company. This is CM style income statement. And this is our DOL problem. And so we have 37, we have 28, we have the difference between those two. That's our unit CM. We have fixed costs. And we have 113,996 is our volume, our sales units. So our degree of operating leverage, we have this amount of unit contribution margin, and this is the volume, so we can get our total contribution margin from that, right? We can say this number of sales times $9 per unit as our contribution gives us $1.025 million as our total contribution margin. Great. That's the numerator for degree of operating leverage. The denominator is profit, which if we look up here, we're just talking about that total CM minus the fixed costs. Total CM minus the fixed costs. This is our profit. Great. Take numerator divided by the denominator. 1.46 should be our degree of operating leverage. Let's see if it will accept that. All right, questions on this problem here? Want to see a cell, what I've programmed in here, anywhere? It's often a request. Can you look at that cell again? Show me what the formula is there. That's okay. No? All right. Let's try this. Let's see if we succeeded. No, we've got special order problems we can do before we test out whether we got all the problems right. All right, so Smug Incorporated, let's look at the question. Minimum acceptable order price for t-shirt for the special order. All right, two styles of problems for a special order. I will either ask you the ceiling or the floor, because there are a variety of different ways of setting, I'm sorry. I got into transfer price brain there for a second, sorry. Because we're trying to negotiate with the special person, the special customer, where exactly the price for the special order will be. This is how we got into this problem. In the textbook, I talk about, yes, special order was mentioned in chapter 2. You can either accept the special order or reject it if they come at you with a firm price. But a lot of times, they're negotiable. Yeah, you're special, but you're not that special. Or, oh no, you're more special than we thought. How special is this customer that we're willing to move the price around? And so, in order to enter those negotiations, you should know what the ceiling is for those negotiations and what the floor should be, what the economic floor should be. So the ceiling is deceptively easy, and usually people get that wrong because they don't read the question stem and realize that I'm asking a ceiling problem. This was the floor, which requires more calculation. So let's focus on that right now. So special order floor problem. So now let's read the fact pattern here. So Smug Incorporated makes custom t-shirts. The firm specializes in commemorative t-shirts for large gathering of baby boomers. The firm typically sells shirts, funny mood this day. Typically sells shirts of $10 each, for $10 each. Each shirt costs $3 in variable costs. All right, so typical normal sales are $10 in price, $3 in variable costs, $7 contribution margin. We'll need that information later. Organizers for one such gathering approached the firm asking for a special order of Kentucky Derby themed shirt. They need 1,000 units for the order. So that's the Q. That's the quantity for the order. Let's go down to where I talk about this in the textbook. We need 1,000 units for the special order. There are two unique circumstances, of course. To use the Kentucky Derby logo, we're going to have to pay $4,000 in royalties. $4,000 copyright payments. That's a fixed cost to accept this order. Accepting this order requires us to pay $4,000, period. The second fixed cost is that we can't produce this with the excess capacity that we have. So we are maybe pumping out 1,000, 2,000, 3,000 for normal paying customers, and we only have 750 units left. But we got to fill an order of 1,000. So we need to sprinkle some pixie dust on there and make 250 extra units, right? That's not an option usually. No, that's not what we're gonna. Don't. It's never an option in the question here. Instead, what we have to do is we have to kick out 250 paying customers, regular paying customers, to fill this order. And so, one of the fixed costs of accepting this order is the loss of contribution margin from those regular paying customers. Remember, they give us $7 in contribution per customer, so we're going to lose $7 times that 250 units of sales we're going to lose to accept this order. So we need to incorporate that loss into the floor of the price we negotiate for this special order. Otherwise, we're not getting paid back for the fact that we're not making 250 shirt sales that we otherwise would on regular paying customers. So, so let's set this up. So we're looking for the price. No, not that way. We know 10 is the regular sales price per unit. Why did I go 2 over? 3 is our variable cost. That's how much it costs us to make them. Which means we have unit contribution margin of $7. We have a quantity. This is the sales order quantity, Q in the equation, in the textbook. There we go. Now we have a $4,000 fixed cost number 1, part of F, right here. But then we also have the fixed cost, which is the opportunity cost of accepting the order. The opportunity cost of accepting the order goes like this. We have 750 excess capacity. We need 1,000. I'll just copy that down. Good. That means that lost unit sales of 250 by accepting the order. Given unit contribution margin of sales of $7, now we have lost CM from accepting the order, i.e. opportunity cost. I glossed over the definition of opportunity cost when I talked about chapter 2. Important topic, important term. It's the cost of choosing one option because you miss out on other options you could have chosen. And that's what we're doing right here. So we have these 2 fixed costs. This is also, I will just make a new. Going to get all messy. Copy it up here. And I will indent this so it looks a little bit more natural. There we go. Meant to do that. So our total F is these 2 together. We have this copyright cost we're going to have to pay to accept the order at all, to put that logo on our jerseys. And we're also going to lose, because we have insufficient capacity to fill the order with what we have just extra left over, we're going to lose some customers. That's going to cost us $17.50 in contribution margin. So that's our total F. And then we just go through, and our P equals this F divided by Q plus our variable cost. So that should be, I did something wrong here. I messed up that cell reference. There we go, I got it. 8.75 should be the right answer there. So that incorporates $3 of variable cost, and then, I'll do this. This should be our P. Let me break it down. We have to cover our variable cost per shirt. This is our variable cost, and we have to cover the fixed cost per shirt. Per shirt. So we have to charge each shirt $5.75 to make up for the fact that the overall 1,000 unit order will cost us $4,000 for the logo and $17.50 for lost contribution margin from regular paying customers. Those are the 2 components. They go into that. And I'll make it look fancy too. So that's the right answer right there. That's what we're gonna go with. That's our floor. So we have the chance to negotiate between these 2 points. And so I gave the game away. This is the ceiling. The ceiling is what regular paying customers pay. Nobody goes in, I want a special order. I'm going to charge you more than if you just went to the online store. Nobody accept. Well, maybe Michael Scott would accept that, but nobody really in business would accept that. That's the ceiling. So the buyer sets the ceiling, the seller sets the floor. That's the typical arrangement here. And that's how these problems are going to set up. So if it asks for the maximum acceptable price or the ceiling, you'd say $10. And you could say it really quickly. You could just read, once you read the questions, tell me, oh, we're looking for a ceiling. Well, let me find, what do normal people pay? Normal people pay? They pay $10. Great, that's the ceiling. So you're going to negotiate with this customer somewhere between those two. You got $1.25 of variance there, of range there. Now, if the floor is above the ceiling, anybody seen those Jeep tire covers where they say problem, no problem? Well, if the right side up says no problem, but then written upside down is problem, because if the Jeep is flipped, that's the problem. Okay. I got about the level of laugh from that deserved. But that's what we're facing if the floor is higher than the ceiling. That's a problem. That means there's no economically possible negotiation that can be reached. The buyer and the seller are never going to agree. All right, so let's check our answers real quick. I hear people packing up. Just give me a second. I'm just going to check the answer, make sure we got everything right. If not, I'll have to amend things. I answered 1, 2, 3, 4 questions. Let's see if I got them right. Should be getting then what is that? 10 points. Yep, good. Okay, we got them. All right, I'll pack up. Oh, we done no holiday Monday. Monday, assuming no more snowpocalypse comes, we'll start talking about chapter 4 and hopefully get through that nicely so that by next Friday you're aces at chapters 3 and 4 and we'll be good. Thank you very much.